President Trump has widened the global trade war. He's announced a 25% tariff on all cars imported into the United States. The measures would spur growth in the US car industry and create jobs and investment.
What if a single purchasing decision by ordinary Canadian households quietly triggers billions of dollars in losses for the United States auto industry without a single new tariff being announced? In the middle of an intensifying trade war, with tariffs reshaping supply chains across North America, Canada is demonstrating something far more disruptive than government retaliation. It is showing how consumer behavior alone can alter the balance of trade. Automobiles, the second largest household expense after housing, sit directly at the center of this shift. Canada is the largest foreign buyer of vehicles manufactured in the United States. Tens of billions of dollars flow south every year as Canadian consumers purchase American-built cars and trucks. That money sustains factories, employment, and entire regional economies inside the United States. Canadian consumers have already proven, through record-breaking domestic tourism spending, that they are willing to redirect demand away from the United States when trade tensions rise. The data now raises a far more serious question for Washington. What happens if that same logic is applied to automobiles? If even a fraction of Canadian buyers change course, the consequences for the United States auto sector could be severe. And before we look at projections or political reactions, there is one hard number from this past summer that forces a complete rethink of North American trade. A number so large that it briefly surpassed the value of Canada's oil exports in the same period. When you hear it, the auto industry implications become impossible to ignore. Stay with us, because this is where the real risk to the American auto market begins. To understand why the North American auto industry is now exposed in this trade war, we need to start with a set of numbers that most analysts initially overlooked. Between May and August of the year 2025, Canada's tourism sector generated approximately 59 billion Canadian dollars in total spending, according to Statistics Canada. That figure represents the highest summer tourism revenue ever recorded in the country's history, and it reflects a year-over-year increase of roughly 6% compared to the same period 1 year earlier. On its own, that number is impressive. But its real significance only becomes clear when it is placed beside another sector that Washington traditionally views as far more important. In the year 2024, Canada's total crude oil exports were valued at approximately 153 billion Canadian dollars, spread evenly across 12 months. That translates into just under 13 billion Canadian dollars per month. Over a 4-month period, that equals roughly 51 billion Canadian dollars. In other words, during the core summer months, tourism inside Canada generated more economic value than oil exports did over the same time frame. This matters because tourism is not an export-driven sector controlled by trade negotiations or tariffs. It is a direct reflection of consumer choice. Canadians did not increase tourism spending because of new legislation or subsidies. They did so because they chose to spend their money at home rather than abroad. The data also shows a crucial asymmetry. While domestic tourism surged, spending by visitors from the United States declined modestly. The drop was not dramatic, but it was consistent and measurable. Even a small shift mattered, because Canada is one of the most important outbound tourism markets for the United States. This is where the parallel to automobiles becomes unavoidable. Tourism and vehicle purchases share one critical feature. Both represent discretionary spending decisions made by households, both involve large sums of money, and both determine where economic activity ultimately circulates. If Canadian consumers can redirect nearly $60 billion in tourism spending in a single summer, the question for Washington is no longer theoretical. It is operational. Because the next set of numbers involves automobiles, and they are far larger, far more concentrated, and far more dangerous for the United States economy than tourism ever was. Stay with us, because once we apply this same consumer behavior to the auto market, the scale of potential disruption becomes impossible to dismiss. Among all categories of consumer spending, automobiles carry a level of economic leverage that few policymakers fully acknowledge. A vehicle purchase is not a routine transaction. It is a concentrated transfer of wealth that connects households directly to factories, wages, regional employment, and long-term industrial planning. In the context of an escalating trade war, this makes automobiles uniquely powerful. For the United States, this exposure is especially acute because Canada occupies a singular position in the North American auto market. Canada is not merely a neighboring buyer. It is the largest foreign destination for vehicles manufactured in the United States. Every year, Canadian consumers absorb an enormous share of American vehicle output, providing stability to an industry that operates on thin margins and long investment cycles. This is where tariffs complicate rather than protect. Tariffs are designed to influence prices, not consumer psychology. When tariffs rise, they can make imports more expensive, but they also invite buyers to reconsider the entire premise of their purchase. Once that shift begins, demand does not simply move to a different supplier. It can retreat altogether or be redirected toward domestic alternatives. Automobiles magnify this effect because of their scale. A household that decides not to purchase an American-built vehicle is not withholding a minor expense. It is redirecting tens of thousands of dollars in a single decision. When that choice is repeated across thousands or millions of households, the cumulative effect becomes systemic. Unlike tourism, which is seasonal and flexible, the auto industry is rigid. Factories cannot easily scale production up or down without consequences. Tooling, labor contracts, and supply agreements are fixed years in advance. When demand weakens, production cuts are not gradual, they are abrupt. This rigidity turns consumer hesitation into an immediate risk for the United States economy. A relatively small decline in Canadian demand can translate into excess inventory, idle capacity, and pressure to reduce shifts. Over time, this pressure moves from balance sheets to payrolls. The trade war adds a further layer of vulnerability. As tariffs raise costs and reduce predictability, automakers face higher input expenses at the same time that export demand becomes less reliable. This is not a scenario in which companies can simply wait for conditions to improve. Strategic decisions must be made quickly, and those decisions depend on one question above all others. Where is demand most secure? If Canadian consumers begin signaling that demand is stronger for vehicles assembled domestically or sourced outside the United States, capital will follow that signal. Production always follows demand, not political promises. This is why automobiles represent the most dangerous consumer decision for the United States in this trade war. Not because of ideology, but because of arithmetic. To understand the stakes, it is essential to see where Canadian auto spending actually goes once it crosses the border. Vehicle exports from the United States to Canada do not benefit a single company or region. They support a dense network of assembly plants, parts suppliers, logistics firms, dealerships, and service providers. Many of these operations are concentrated in specific states, where auto manufacturing is not just an industry, but the backbone of local economies. When Canadian consumers purchase vehicles built in the United States, they are indirectly supporting wages, healthcare benefits, and municipal tax bases in those communities. Schools, infrastructure, and local services all depend on the continuity of that economic activity. This is why shifts in export demand are felt so quickly and so deeply. If Canadian demand softens, inventory accumulates. Dealers respond by cutting orders, manufacturers respond by slowing production. Suppliers respond by reducing output. The chain reaction is swift, and it rarely stops at the factory gate. The trade war amplifies this sensitivity. As tariffs distort pricing and raise uncertainty, companies lose the ability to plan with confidence. Investment decisions are delayed. Hiring freezes become more common. Temporary reductions quietly become permanent. What makes this moment particularly unsettling for policymakers in Washington is that these risks are not being driven by a formal boycott or a diplomatic rupture. They are emerging from individual consumer choices, repeated at scale. Canada has already demonstrated this mechanism through tourism. Households chose to vacation domestically, and nearly 60 billion Canadian dollars remained inside the national economy over a single summer. That money circulated through hotels, restaurants, transportation, and local services, creating jobs and reinforcing regional growth. Automobiles represent the same mechanism, but with higher stakes. If Canadian households begin applying the same logic to vehicle purchases, the resulting shift will not be gradual. It will be concentrated, measurable, and difficult to reverse. Once manufacturers adjust production plans and investment strategies, returning to previous patterns becomes unlikely. For the United States, the warning embedded in this shift is clear. Trade wars are no longer fought only through tariffs and negotiations. They are increasingly shaped by consumer behavior that governments cannot easily command or undo. And this raises a question that policymakers in Washington may not be ready to confront. If consumer-driven trade realignment is already undermining one of the most important export relationships in North America, how long can the current strategy remain sustainable? Stay with us, because the next section examines how these dynamics are beginning to surface inside the United States itself, and why the social and employment consequences may arrive sooner than expected. The first visible consequences of a consumer-driven shift in the auto market would not appear in political headlines. They would appear quietly inside factories, supplier contracts, and regional labor statistics across the United States. Automobile manufacturing in the United States is highly concentrated. Entire communities depend on a small number of plants operating at near full capacity to remain economically viable. When Canadian demand supports those facilities, production schedules remain stable. When that demand weakens, even modestly, the system begins to strain. Vehicle manufacturing does not adjust smoothly. Output is planned months or years in advance. When export orders decline, manufacturers are left with excess inventory and idle capacity. The initial response is often reduced overtime or temporary shutdowns. Over time, those measures escalate into shift eliminations and workforce reductions. The social consequences extend beyond the factory floor. Auto plants anchor local economies. Workers spend wages in nearby businesses. Municipal governments rely on tax revenue tied directly to industrial activity. Schools, healthcare services, and public infrastructure are all affected when employment weakens. A decline in Canadian vehicle purchases would therefore produce a cascade of economic stress that spreads far beyond the auto sector itself. The trade war magnifies these risks. Tariffs increase input costs, compress margins, and reduce flexibility. Manufacturers facing higher costs and declining export demand simultaneously have limited options. They must either cut expenses, delay investment, or seek alternative markets. None of those options protects employment in the short term. What makes the situation particularly sensitive is timing. The auto industry is already navigating structural pressures related to electrification, technology investment, and shifting consumer preferences. Export instability adds another layer of uncertainty at a moment when companies are least equipped to absorb shocks. For policymakers in Washington, the challenge is that these developments unfold incrementally. There is no single moment of collapse. Instead, warning signs appear gradually in employment data, regional growth figures, and corporate earnings reports. By the time the problem becomes visible at the national level, the damage has often already been done. This is why consumer behavior represents such a difficult variable to manage. Governments can negotiate tariffs and issue policy guidance, but they cannot compel households to maintain purchasing patterns once confidence erodes. While the United States faces downside risk, Canada experiences a different set of dynamics. A shift toward domestically assembled vehicles would reinforce existing manufacturing clusters, particularly in Ontario. These facilities already possess skilled labor, integrated supply chains, and access to global markets. An increase in domestic demand would strengthen their position at a critical moment for long-term planning. Higher demand would encourage manufacturers to allocate production capacity accordingly. Additional shifts would increase employment. Suppliers would expand output. Investment decisions that might otherwise be delayed would gain urgency. The effects would extend into logistics, engineering services, and local retail economies. The pattern mirrors what has already occurred in tourism. When Canadian households redirected vacation spending domestically, the benefits multiplied. Employment increased, wages stabilized, regional economies strengthened. The same multiplier effect applies to vehicle manufacturing, but with higher wages and longer-term investment horizons. This does not mean the transition would be painless. Automobile production is capital-intensive. Scaling output requires coordination across suppliers and regulators. Inflationary pressures could emerge if demand outpaces capacity. And Canada remains deeply integrated into the North American auto ecosystem, meaning disruption in the United States would eventually feed back into Canadian operations as well. However, from a strategic perspective, the balance of risk favors demand stability. When consumers spend domestically, money circulates within the national economy multiple times. Wages earned are spent locally. Tax revenue supports public services. Investment reinforces productive capacity. Over time, this creates resilience against external shocks, including those generated by trade wars and tariffs. This is why the shift underway matters beyond immediate economic metrics. It signals a reorientation of priorities. Households are no longer viewing large purchases as neutral transactions. They are increasingly aware that spending decisions shape national outcomes. For Canada, this awareness translates into leverage. Not leverage exercised through retaliation or policy threats, but through consistent, decentralized consumer behavior. That form of leverage is difficult to counter because it does not depend on coordination or enforcement. For the United States, the implications are uncomfortable. Traditional tools of trade policy are poorly suited to address demand shifts driven by consumer sentiment rather than price alone. Once confidence in a market erodes, restoring it becomes far more challenging than protecting it in the first place. And this leads directly to the next issue facing policymakers in Washington. If employment risks are rising quietly and investment decisions are already being reconsidered, how is the United States government interpreting these signals, and what options remain available as the trade war continues? Stay with us, because the next section examines the policy dilemma emerging in Washington and how global partners are positioning themselves in response. For policymakers in Washington, the emerging shift in Canadian consumer behavior presents a strategic dilemma that traditional trade tools are poorly equipped to solve. Tariffs are designed to influence price competitiveness. They are blunt instruments meant to protect domestic industries by raising the cost of foreign alternatives. In previous trade disputes, this approach assumed that demand would remain largely intact, merely redirected toward domestic producers. The current trade war challenges that assumption. What the data now suggests is that demand itself is becoming elastic in ways policymakers did not anticipate. Canadian consumers are not simply choosing different suppliers. In many cases, they are redefining the decision altogether. They are reassessing whether to purchase from the United States at all. This distinction matters. When demand erodes rather than shifts, tariffs lose their effectiveness. Raising barriers does not bring production home if consumers respond by reducing or reallocating spending. In the case of automobiles, this risk is especially acute because the sector depends on scale, predictability, and long-term planning. Washington now faces an uncomfortable reality. Maintaining tariffs may continue to signal political resolve, but it also accelerates uncertainty among buyers and producers alike. Reducing tariffs, on the other hand, risks appearing to concede leverage without guaranteeing that consumer confidence will return. This leaves policymakers with limited options. They can attempt to offset demand weakness through subsidies or incentives, but such measures strain public finances and invite political backlash. They can pursue diplomatic de-escalation, but trust once damaged is difficult to restore quickly. Or they can maintain the current course and hope that consumer behavior stabilizes on its own. None of these options offer immediate relief to regions dependent on auto exports to Canada. The deeper problem is that consumer-driven trade realignment operates outside the timeline of elections and policy cycles. Households adjust behavior gradually, based on perception and experience rather than official announcements. By the time policy responses take effect, purchasing habits may already be entrenched. This creates a structural mismatch between the pace of government action and the speed of consumer adaptation. For the United States, the risk is not that one trade war skirmish goes poorly. It is that a key export relationship weakens quietly without a clear trigger point that demands intervention. While Washington debates its next move, other global actors are watching closely and adjusting accordingly. For many advanced economies, Canada's experience offers a case study in demand diversification. European and Asian partners recognize that trade wars between major economies create openings for alternative suppliers and new partnerships. As Canadian consumers and policymakers explore ways to reduce exposure to United States market volatility, interest from abroad increases. In the automotive sector, this interest is particularly pronounced. Manufacturers and governments outside North America see an opportunity to deepen ties with Canada through investment, technology, cooperation, and market access. These discussions do not necessarily replace existing relationships with the United States, but they dilute its centrality. This dynamic extends beyond automobiles. Energy, agriculture, and advanced manufacturing all follow similar patterns. When tariffs introduce friction, trade flows seek paths of least resistance. Over time, those paths harden into new supply chains that persist even after political tensions ease. For Canada, this diversification strategy reduces vulnerability. For the United States, it represents a gradual erosion of influence that is difficult to measure in real time but significant over the long term. International institutions and analysts increasingly emphasize resilience over efficiency. The lesson many governments are drawing is that over-reliance on any single market carries strategic risk. Trade wars accelerate this reassessment. What makes the current moment distinctive is the role of consumers in reinforcing these shifts. When households align spending decisions with broader economic narratives, market signals become stronger and more persistent. Investment follows. Capacity adjusts, trade patterns change. From Washington's perspective, this introduces a new layer of complexity. Diplomatic engagement alone may not be sufficient to reverse trends that are now embedded in private sector behavior. And this leads to the most consequential question yet. If consumer-driven trade realignment continues to reshape the auto market and influence global positioning, what does this mean for the long-term balance of economic power in North America? Stay with us, because the next section explores the deeper strategic implications and the twist that policymakers may not yet fully appreciate. For decades, trade strategy was defined almost exclusively by governments. Treaties were signed, tariffs were imposed or removed, supply chains adjusted in response to policy decisions negotiated behind closed doors. Consumers were largely passive participants, responding to prices rather than shaping outcomes. That model is no longer sufficient. What is emerging in Canada represents a fundamentally different form of trade realignment. It is decentralized, gradual, and driven by individual purchasing decisions rather than official mandates. Millions of consumers, acting independently, are producing effects that once required coordinated government action. This shift matters because it changes the balance of power. When households redirect spending domestically, they create a stable base of demand that encourages investment at home. Manufacturers respond not to political statements, but to sales data. Capital flows toward markets where demand appears durable and predictable. Over time, this reshapes production geography. In the context of the trade war, this consumer-driven approach offers Canada a form of insulation. It reduces reliance on volatile export relationships without provoking direct retaliation. There are no formal barriers to contest at the World Trade Organization. There are no new tariffs to negotiate away. There is simply a pattern of spending that reflects evolving preferences. For policymakers, this presents both an opportunity and a challenge. On one hand, consumer-driven demand strengthens domestic industries organically. On the other hand, it limits the government's ability to fine-tune outcomes. Once habits form, they are difficult to reverse. This applies as much to Canada as it does to the United States. Which brings us to the strategic implication for Washington. If trade wars increasingly operate through consumer behavior rather than policy levers, the United States faces a diminished capacity to shape outcomes through traditional tools. Diplomatic engagement remains important, but it no longer guarantees restoration of demand. The twist in this unfolding story is not economic, it is psychological. Trade wars are often framed as contests of endurance. Governments assume that pressure will eventually force concessions, but consumer-driven shifts do not follow the same logic. They do not escalate quickly, and they do not reverse quickly either. Once trust in a market weakens, restoring it requires more than lower tariffs or renewed agreements. It requires a perception of stability that can persist over time. That perception is fragile. In the case of automobiles, this matters enormously. A vehicle purchase locks in behavior for years. A household that buys domestically this year is unlikely to return to the market for several more years. During that time, familiarity builds, loyalty develops, new norms form. By the time policymakers recognize the scale of the shift, the window for easy correction may have closed. This is the risk Washington now confronts. Not an immediate collapse, but a slow erosion of a key export relationship that once seemed unshakable. Canada has long been viewed as a guaranteed market. The data now suggests that assumption is no longer safe. The deeper implication is that trade wars may no longer be resolved solely at negotiating tables. They may be settled quietly through millions of individual decisions that no government controls. And this reframes the central question of the entire story. If consumer behavior has become a decisive force in global trade, who is truly steering the economy, and how much influence do governments really retain? Stay with us, because the final section brings this analysis together and asks whether this shift represents a bold strategy or a risky mistake for the United States. What began as a shift in summer travel patterns has evolved into a far more consequential economic signal. Canada's experience demonstrates that consumer behavior is no longer a secondary variable in the trade war. It is a primary force shaping outcomes. Tourism provided the proof. Automobiles now present the test. The data shows that when households redirect spending domestically, the effects ripple through employment, investment, and long-term industrial planning. In Canada, this has reinforced domestic sectors and reduced exposure to external volatility. In the United States, it has introduced uncertainty into an export relationship that was once assumed to be stable. This does not mean that one side has clearly won. Trade wars rarely produce clean victories. What they do produce are structural shifts that are difficult to reverse once they take hold. For Washington, the central question is not whether tariffs can protect domestic industry in the short term. It is whether prolonged trade pressure encourages allies to quietly reconfigure demand in ways that reduce dependence altogether. For Canada, the lesson is equally complex. Consumer-driven strategies create resilience, but they also require sustained confidence and coordination over time. The broader implication is unmistakable. In an era defined by trade wars and tariffs, economic power is increasingly exercised not only by governments and corporations, but by millions of individual consumers making ordinary decisions. The question now facing the United States is simple, but deeply consequential. Is this a bold strategic adjustment to a changing trade landscape, or a risky miscalculation that could permanently reshape the North American auto market? For more fact-based global trade analysis that cuts through rhetoric and focuses on data, subscribe to the channel and stay informed.